Hello, and welcome to the final episode of season three, where we've been exploring across this season how fractional CMOs can help SMEs and portfolio companies accelerate growth and maximize enterprise value. Today, we're diving into a topic that's top of mind for many business owners and investors, and that's how marketing can enhance valuation multiples at exit. Now, while financial performance is critical, marketing can play a significant role in determining how attractive a business is to potential buyers. In this episode, we'll explore how marketing can be leveraged to package a company for buyers, increase its perceived value, and tell a compelling growth story to attract the right acquirers. Joining me today is Rob Nicholls, a strategic CFO, a non-exec director, and board advisor with over 35 years of global finance experience. Rob specialises in profit maximisation and value creation, and today, with his investor hat on, he'll share his insights on how investors and CFOs and CMOs can work together to position the business for successful exit. So let's get started. Rob, welcome to the show. I can see you in your golfing attire there. Are you about to tee off or you just come back?
I'm ready to go, Paul, actually.
Fantastic. Whereabouts are you hitting your golf balls today?
I'm in Devon today at my regular golf course as well, so I've got three guys waiting for me in about 2 hours' time.
Right, so that's an instruction to get this episode recorded quickly then. So shall we dive
Got
in
lots
then?
to say. Got lots to say.
Absolutely. And I guess for some of the listeners who may not know you, as well as being a CFO, you do invest in businesses as well, don't you? So we're looking at today's episode, you're kind of sharing both your investor insights and CFO insights, because the two are kind of linked together a little bit, aren't they, in this piece?
They're very much aligned. I look at when I go into a business, I look very much as if I was investing in that business, or selling the business, or buying the business.
The first topic I want to look at is packaging the company for a potential buyer. So, if you're a business owner and you're preparing for an exit, financial performance is critical, but so too is demonstrating a strong, scalable marketing function. So, Rob, from an investor's or a buyer's perspective, what specific marketing factors make a company more attractive during an acquisition? And what should businesses be doing in advance to position themselves as a strong acquisition target?
So there's a lot to unpick here, Paul. I think the first thing is most sellers, most business owners don't prepare for a sale. They don't understand how long it'll take. They don't understand what's involved in it. Likely as not, they'll only do it once or twice in their lifetime, and most people have never experienced it at all. As I said earlier, I look at things from an investor's perspective. What am I buying? And you'll go through a process called due diligence when you're selling or even buying a business. And one of the things you're clearly going to look at is the marketing function. You're going to look at where the brand is, where the product is, where the service is in the marketplace. So there's a strong role that the marketing function has to maximize the opportunity. And to be honest, as a finance person, as an investor, I'm looking to maximize the value created in a business if I'm looking to sell that business. And brand has a big part to play. The story in the marketplace, the reputation, the lifetime value of a client has a big place to play. The retention numbers, the KPIs around retention is a big factor here as well. But the first thing is most businesses don't prepare. They don't have a strategic plan. They don't have a marketing plan. And that's something that an investor is going to look at quite quickly. They're going to do their due diligence. They're going to look at your customer lists. They're going to look backwards. They're going to look at the financials, quite obviously, what assets they're going to buy, what goodwill is on the balance sheet, what the P&L says, what margins they've generated. But primarily, what the buyer is looking to maximize is the opportunity going forward. They don't buy the previous year's financial results, they don't buy the previous year's customers. So, to my mind, it's all about creating a longer process to generate revenue. So, that's why SaaS businesses, recurring revenue businesses, generally have a higher multiple at exit because they've got either contractual or guaranteed or recurring revenues. And that's something that is often missed by a lot of businesses. If you can generate recurring revenues, you're not just selling one product or one service this month and it's a one time service. that has little to no value creation in the longer term. But if you can create a buyer journey that enhances the trust and relationship you've got with a client, they're going to buy from you on a recurring basis. Often you're going to be able to upsell them to higher value products or services, increase your margin, perhaps increase your pricing over time. That's going to create value in the business. And that's what it's about. The buyer or the investor is looking to acquire the future revenue or earnings stream. They're not really that concerned with what's happened a year or 2 years or 3 years behind, but what is the business going to generate going forwards?
And I think an important thing to bear in mind is a buyer is not going to rely on internal marketing KPIs when they conduct that due diligence. A seller might present the acquirer conversion rates, pipeline metrics, brand awareness stats, but a buyer is going to assess the marketing performance independently. They'll probably outsource it to a marketing specialist agency or an advisory business. And what they're going to be looking at, instead of those kind of metrics, they're going to be looking at the market position. They're going to be looking at, what are the drivers of competitive advantage and the ability of the marketing function in that organization to drive scalable growth before assigning value to that function. And I think, particularly for very early stage businesses that may only be a few years old, maybe the marketing function isn't particularly mature. It might not be very well established. And what any business owner needs to know is that an acquisition process or an exit can take, it can be an 18-month runway there or thereabouts. And so really, if you're planning that exit, your marketing function, it must be structured to demonstrate that scalability and revenue contribution. And you've got that 18-month window to kind of position the marketing function as that growth driver. Otherwise, you might be found out, or you could potentially lose some multiples.
There's a couple of things here. Is one, the good and the bad is that due diligence isn't done nearly as thoroughly or well as it used to be done. So as a buyer or seller, generally it's a cursory look. It's a cursory look at, is there a marketing plan? Where's the customer list? What is the average sales value, and so on and so forth. They'll look at some decent financial metrics. They're not interested in your fluff metrics, your views, your eyeballs, the number of blogs, the number of newsletter subscribers you've got. They're not interested in that, and that perhaps is a good thing. But the important thing from a marketing perspective is to understand that it's about maximizing the value at exit. I've got a client that I'm going to see next week over in Wiltshire, and she has no marketing plan. There's no strategic plan, but she's got an offer for the business. And I know that offer is woefully undervaluing the business. So the potential buyer has looked at the opportunity, they've looked at the IP in the business, they've looked at the contracts, they've looked at the customers, and they said, we can buy this at 50 cents on the dollar. Primarily because there isn't a strategic plan, there are no advisors. The owner in this case has been, I wouldn't say hoodwinked, but she's been convinced that this is a good offer and it's on the table. I'm going to go in there next week, and I would suggest over the next 18 months, we'll probably double the exit value of that business. So she'll no longer be selling for $1.5 million. She'll more likely be selling between 3 and 4 million. And we can increase the multiple. The other thing you've got to understand is, dependent on the business or the industry you're in, that will often determine the exit multiple, either an exit multiple of EBITDA, or my preferred seller metric is an exit multiple of sales. So if you're doing £1 million worth of sales, a 2 times equity might mean you can exit for 2 million. But I've got industries and businesses that are doing 3, 4, 5 million. And if I can get an 8 to 10 times multiple on either EBITDA, preferably on sales, maybe a 4 or 5 or 6 times exit multiple of sales, we're going to generate a whole stack of value for the owner. And this is where having your ducks in line, having a strategic plan, having a marketing plan, having a financial plan, having advisors around you to counsel you and advise you that that's not a good thing to look at. We need to focus on that. We need to invest in the brand. We need to invest in distribution, whatever that investment needs to be. That narrative has to be owned by someone. There's no reason why it shouldn't be owned by the marketing head, the CMO. It could be, it often isn't, is often led by someone like myself as the CFO or the CEO. But it's all about the exit multiple. It's all about valuing the business at the highest valuation you can get. Because I'd rather have my owners, my directors, the people I work with exit at 15 million than exit at 5 or 6 million. And they're going to have a whole better life as a result of that advice and counsel. So there's a huge part to play in terms of realizing that value, and the marketing function has a huge part to play here. And I fear quite often they're not in the game. They're not in the ring. They're not part and parcel. They're not owning the narrative. They're not owning the story. The storytelling has to come down to myself as the CFO or advisor, oftentimes the CEO too.
And I want to go a bit deeper into what you've just said there, Rob. And I previously worked in the corporate finance organisation, and so I've seen how deals operate from the acquirer's side and how the process works. And I've witnessed that a company's valuation multiple, it's not just based on revenue. There's multiple other factors on there. What other things can marketing do to help increase that multiple?
So sometimes you're going to be limited by the market, the industry, the product you sell. If you're selling a one-time product for £1,500, that's fine. There's a place for that. But I want to be selling a product that's £1,500 today. I want to sell it next year and the year after. And I want to have incremental value and services. I want to be able to increase the price on that service as well. So, an ownership of that product delivery and that journey and that customer journey is hugely influenced by the brand, the positioning in the market, being in the right industry. And I think it's something that's largely almost forgotten to some extent by marketing, is that they have a huge part to play in terms of where the business is going and orientating the business or the organization to where the business is going to be 2, 3, 5 years from now, and developing products and services and distribution into those markets and developing the right pricing. A huge part of what drives value in a business is intellectual property and goodwill. And if you've acquired other businesses, you've acquired goodwill. But building your own goodwill in a business is hugely developed on brand investment. So if you've got a brand and you're not investing in it, you're not developing any goodwill. Therefore, you're not really creating a very much value in that business. So it goes to, if you're putting 50,000 a year into brand, whatever mechanisms that is, whether that's blogs, social proof, whether that's customer journeys, whatever it is to develop the brand, you're creating value in the business that will be realized at a point in time when there's a transaction potentially. Most businesses will, over time, within the next 3 to 5 years or 5 to 10 years, there will be a transaction that they have to enter where the value of the business is determined by the investments you've made this year and next year. So I'm a huge believer in investing in the brand and recognizing that you'll see the value come out the other end. £50,000 this year might generate a business that's worth 2 or 3x what it is today in 3 to 5 years' time. And it's something that's really not recognized and understood nearly enough in business today in the UK.
Yeah, and you touched on earlier the SaaS businesses. They have the recurring revenue model. I think anyone that's not in SaaS can kind of look to SaaS and think, actually, maybe we can create a pricing model that replicates that. Maybe in professional services, for example, there might be an AIR model that you can implement. And I think as a buyer, if you're confident that the business you're buying, it does have predictable revenue, it has scalability in the future, there are cross-selling opportunities within the organization to upsell, cross-sell, whatever, that will just lead to stronger long-term growth projections. And I think you mentioned also about brand equity positively impacting valuation. If your marketing function can create brand equity If you can create a brand that enables higher pricing power, stronger customer retention, increased bargaining power in the value chain, that's really going to help an acquirer. It's going to mitigate any objections they may have in terms of buying the business. They'll have more confidence in paying a fair price for that organization. And I think also marketing, it needs to demonstrate long-term brand resonance. So buyers aren't just looking at recent sales, they want to see multi-year brand traction. And I think if marketing has created a loyal customer base, which is built around a strong brand recall, again, it reduces risk for a potential buyer, it increases the value.
Yeah, and I think there's a couple of things to play in here. Sales are obvious, but a strong brand through investment over time is going to increase your margins. It's going to enable you to price and take price when you determine you need or want to take price. So that will often determine an expanding margin profile. You never want to be looking at, people won't look at businesses where the margin profile is contracting over a period of time. So that, you're developing strong sales growth. Good expanding margins will increase profitability substantially, which will therefore create value. And it's those real 3 or 4 things that play into the creation of business value. And brand has a huge part to play in it. Marketing has a huge part to play in this. They're just not really stepping up to a large extent now in creating the conditions where you can see expanding sales, not just 5, 10, 15% sales growth. I want to see sales growth from low single digits to double digits to high double digits. And any business that I go into, if they're seeing 5, 10% growth, I want to be seeing 15, 20, 30% growth every year, every quarter, every year. I want to see expanding margins. I want to see expanding pricing on those products or services, because that is what's going to be valued by anyone looking at the business, either as an investor or an acquirer or a PE firm, venture capital firm, someone looking to acquire other businesses in that world. That's what they're looking at. Growth in sales, expanding margins, increased profitability, and value creation. And marketing has a huge part to play in this scheme.
That's a pretty good segue into the final topic in this episode, and that's how marketing can help create the story to attract the right sort of buyers. Rob, I think you mentioned in an earlier episode that buyers, that they don't just want a profitable business, they want a compelling growth story. And so the right marketing strategy can help craft that narrative, highlighting, the business's market leadership, its strong customer demand, and future potential. So, Rob, how important is storytelling in the exit process, and what role does marketing play in shaping the company's growth narrative?
I'll give you an example where I think it's played in here. I had a client about 3 years ago that we led through an exit where a large regional retailer bought 45% of the business. We'd segmented the business, if you will, and honed in on the high value, high margin, repeatable businesses. So this wasn't selling a system and then going away and never selling another system to that industry or that industry group, but it was honing in on where do we have a unique value proposition for the client in an industry group that we can generate frequent repeat business and develop a profile of clients that an acquirer will really find attractive. And there was a number of things that played into that. Social media played into that as well. Strategic partnerships with other people in the industry played into that, such that my client, which we secured an exit for, basically became the number one supplier of choice of that product, with repeatable businesses, with strong strategic alliances, and they got acquired. It was a very attractive proposition. And we had developed a good storyline, a good narrative. We told a good story. It was repeated. It was repeated by other people when we weren't in the room, so that people were talking about the brand because we'd seeded the marketplace, we'd nurtured the marketplace, we'd developed a strong brand identity, and that people talked about us and referred businesses in, and other strategic partners came on board and they lifted the brand further. And it just created a very compelling storyline and narrative that the CEO and myself, who was playing point on it, was able to secure a good a strong valuation for the business that generally, 3 years prior, we would not have been able to do.
Yeah, and I think marketing teams, marketing leaders in organizations, if they're struggling with campaigns to drive demand, they will really struggle to do that storytelling well when it comes to that exit opportunity. And if you're a business owner, you don't have much faith in your marketing team, outsource it to a PR agency, and you've got an 18-month campaign to really sell the business and position it in the best way. And buyers, they'll be looking for companies that outperform their industry, and really that PR campaign, that content strategy, it's got to demonstrate how your business is gaining market share, how you're innovating in customer acquisition, how you're innovating the product or the service, and how you position yourself ahead of competitors. And I think the other thing, I guess another important point to make is the growth rate has to exceed industry benchmarks. So you need to demonstrate that as well as part of that storytelling, as part of that content strategy. A strategic buyer is going to seek businesses that scale faster than the market average. So if you can demonstrate that through case studies or your numbers, that again is going to be quite attractive to a strategic buyer.
It's a really good point. If you're growing at 5%, the industry is growing at 10%, no one's going to be interested in you. You're underperforming. If the industry is growing at 15%, but you're growing at 30%, then I'm interested, and you're going to generate a higher multiple. So it's all about the narrative. It's all about the story you're telling. It's all about positioning yourself in the right way. And marketing is a huge part to play here. Sales, not so much. The finance lead, generally, the CFO will often play point on this in terms of directing the narrative. And that's unfortunate. That's just the way it is today. The CEO and the CFO are basically locked in at the hip here. But it's the story you're telling. It's the brand equity you've built. It's the goodwill. It's the clients you've brought on board. Any acquirer, any business that's acquiring another business, they're going to look at the client list. They're going to look at what the value is, what the cross-selling opportunity is, how pricing has been taken. In the number of businesses that I go into and they haven't taken price over the last couple of years, that's no way to run a business. I often give the example of some of the businesses I looked at in the US, where they'll take multiple price increases on an annual basis, and they won't lose clients. They won't lose business. Business will just scale. They'll often sell more units, more tickets at a higher price, and therefore generate revenue. And that's what I think we've lost to some extent, is understanding that it's all about driving growth over the long term, exceeding the market, exceeding what you've done prior. You might have grown 15% last year, but you need to be growing high double digits next year. And you need to be thinking bigger. You need to be thinking, where are we going with this? Who can we build into our ecosystem? What partnerships we can build? What bridges can we build? What story do we need to tell? And it goes to brand. It goes to investment in the brand and how that's being told and how other people are talking about you. That's the best brand equity you can build, is other people talking about yourself, about your business in the marketplace. It's not nearly done enough. And I think marketing clearly needs to step up their game on this, because they're just not really doing nearly enough as they should be.
And on that, that's probably a good point to close this show and sadly this season. If you've been streaming this season's episodes, I hope you found value from everything that's been discussed between Rob and myself. Rob, I'd really like to, personally thank you for freeing up your time from the golf course to share your perspectives across these 10 episodes. They've kind of flown by, but I've really enjoyed every single show. And again, thank you for your time and your insights and your nuggets of wisdom there. They've been really valuable.
Pleasure. It's been really very enjoyable joining you every week. And if anyone wants to get in contact with me, if anyone wants to pick my brains or argue with me, just reach out and connect with me on LinkedIn.
And all of Rob's contact details and links will be part of these show notes, as always. Rob, thanks again. Good luck with the golf. Get a hole in one, and I wish you all the very best with your clients.
Cheers, Paul.